So the UK released their retail sales data today, and it has missed by a large margin. We're going to take a look at that. And gold, yesterday we mentioned that it was a fantastic way to play escalation or de-escalation in a war. And unfortunately, we did end up getting a bit of escalation. We're also going to focus on the yellow metal today. And the trading takeout is going to be why you need to be able to change your mind super, super quickly. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So yes, about an hour ago, the UK retail sales data year on year and month on month came out. Year on year came out super, super bad. The actual rate was -1% versus the expected of -0.1%. The previous was -1.4%. So there's a bit of disinflation, if you like, on the concurrent time series, but it's still very, very bad based on expectations. And the month on month obviously wouldn't have been any better either. -0.9% versus expected -0.2%. What is this identifying? Well, in my view, it is identifying what we saw last week with payrolls, is that there's actually about 19,000 fewer jobs in the UK than there were 2 or 3 months ago, or expected to be 2 or 3 months ago. There was a big revision on the last month's data. And that showed really, I think, that there is less pressure on wage growth here. You know, wage growth in the UK nominally for the last couple of months to a year now has been quite strong. And the problem is that if that's drying up, then obviously demand's going to dry up as well. Things are still relatively more expensive than they were 2 or 3 years ago. And so if people are buying less because their perception of the cost is too high or too great, then naturally demand is going to collapse. And we're now seeing that in the UK retail sales data. Interestingly, BOE's Bailey mentioned this. He said he expected a market fall in inflation next month. September inflation figures were not far from what the Bank of England had expected. Core inflation fell slightly from what we had expected, and this is quite encouraging. Pay growth as measured is still well above anything consistent with the inflation target. I don't agree with that at all. I think that is just something that they have maintained for quite a while now. If you remember, Hugh Pill said that people have to get used to becoming poorer, which is just a ridiculous statement to make. But whether it's true or not, you know, there's some political message in there that probably would go down with the public better. But this is in line with what they've been saying. It's fine for Bailey to say that he's on half a bar a year, 500k a year. So yeah, he's doing all right. But you know, for someone on the average salary, which is about 32,000, I think, maybe it's less. I don't know. Doesn't really help, does it? Still a really, really bad situation. So, yeah, it's an interesting one. And the pound has reacted off the back of it. In fact, I'm just going to pull up sterling here, switch to this tab. And we did see a fall in the pound to a new weekly low. You know, it only fell to yesterday's low. So there was no considerable reaction, but I do expect some follow through now. I would expect perhaps the market to start dropping down to this low, or at least this level where we reacted before. So about 120.5. It's now at 121.07. So about 60 ticks or so. But yes, it's probably created a now midterm divergence between now and next month in terms of gilts versus US yields. US bond yields are absolutely rocketing. I think we've seen that. US gilts are slightly softer in terms of the yield. So that spread is going to widen, meaning that the pound remains a bit depressed and the dollar, I think, starts to get a real bid here. We've seen the euro come off a little bit overnight. And so, yeah, I think that's what the play is here in FX land. Now, yesterday we had mentioned gold and the reasons for why, you know, it might be rallying and then perhaps even collapsing. And it's purely down to escalation versus de-escalation. In this case, yesterday, we saw the escalation in the early evening. We believe, or what reports have said, is that drones were sent to attack a US warship. There was a base that was attacked on the Syria, Jordanian, and Iraqi border, which I think injured some US troops. And, this is just an example of how gold can react in this kind of a market. When people are looking for specific reasons to fly to safety, and bonds aren't safe right now, they're probably going to look at gold. And so that's exactly what happened. We put the video out just around here. And then later in the evening, gold rallied heavily. I think there is an element as well that central bank buy-in is making a bit of a support in gold too. So China had been a massive buyer throughout the year of gold. Other central banks, Uzbekistani, I think Turkmenistan central bank, Turkish central bank, quite a few African central banks, they have also been buying as well. So it seems to me like there has been a real desire to hold bullion, not necessarily paper, but to hold bullion in case any geopolitical risk does pop off. And that's exactly what we're seeing now. We're seeing the geopolitical risk show itself, and gold is reacting probably exactly the same way that you would expect when there's not enough safe haven assets out there. In terms of where we go next, I think it would be very, very interesting to take a look at these levels, up at 2K again. There's some nice highs up here. So 2027 bucks, for example, could potentially reach back up to these kind of highs, up here, 2082. But I don't know. I wouldn't like to see the situation that we'd be in if we were up at 2145, to be honest. That wouldn't be very pretty, I don't think. However, the chart is sort of looking that way. It's looking as if there's a big low here that hasn't been breached. It's tested here again, and then just rallied off. So perhaps that is the play. Perhaps we do just keep extending higher and gold bugs get their day finally. It would be an unfortunate reason as to why it start ticking up there, though, in my view. So don't bet too hard on it. I wouldn't like to see the situation that we're in if gold keeps going. So one of my favorite quotes, and I don't know actually who came up with it, but it's basically to have strong opinions loosely held. And that is today's Trading Takeout, is to be able to, have high conviction in something, but the second that it looks like your conviction is wrong, basically, is to completely dump that idea and therefore dump that bet. Because one of the biggest problems with traders is that they get stuck in the mindset that, oh gosh, I'm wrong on this, but I think there's a way out. Let me just, try and work my way out of this trade, when the easiest thing is just to cut yourself free of it and start again. Because if you try and worm your way out of something, you tend to end up making the situation a lot worse. I think one of the key things to do is just to be able to say to yourself, right, that's it. It's just a loss. Move on. It's not that painful at the end of the day. It's a cost of doing business. I always like to use this example where, if you're a retailer, you have to buy stock before it's even sold. That's an outlay that already, goes out. You have a cost already for your stock. It's the same as trading. You have a cost that you're willing to put up, basically, which is your commissions and your stop loss risk. And then you're looking to just make reward. A shop owner doesn't know if he's going to make profit that week or not at the end of the day. So you've got to be thinking exactly the same as a shop owner.